Every few weeks, another must-own stock hits the market, and retail investors are rushing the gates to get a piece of it. We are seeing a volume of initial public offerings that feels almost relentless. Last fiscal year, 108 companies went public, raising 1.76 trillion INR. But this massive wave creates a bottleneck. Millions of individual investors are now fighting for a tiny allocation sliver of that capital pool. Most applicants are operating on a specific expectation that simply securing an allotment is a guaranteed path to instant wealth on the day of listing. However, when you have over 100 companies crowding the gate and millions of people fighting for the same shares, the sheer volume of competition creates a ceiling on what a single retail account can actually expect. To see what's actually happening to that profit potential, we have to look past the marketing and check the recent performance data from KPMG. In 2024, investors saw a 28%. Today, that average has dropped to just 8%. On a standard retail investment of 15,000 rupees, your gain is 1,200 rupees. And to get that, your capital is frozen, completely illiquid for 2 weeks. You're forced to ask if a single-digit return is worth the risk of locking away your liquid capital in an increasingly volatile market. Based on these numbers, treating an IPO as a high-yield, short-term lottery ticket is no longer a statistically sound strategy. To understand why those margins are shrinking, we have to look at the mechanics of how companies set their price tag. In a fixed-price issue, a company sets a specific non-negotiable cost per share before the subscription period even starts. This chart illustrates the trap. If the broader market crashes while your application is pending, the fixed price remains stuck at the old, higher valuation. You're essentially buying an asset that is already overpriced. This is why most major IPOs today use book building instead. In book building, investors bid within a designated price band. You can see here how bids accumulate at different levels within that range. But because institutional demand is so high, the final price is almost always pushed to the absolute ceiling of that band. If a retail investor wants any realistic chance of getting shares, they are essentially forced to bid at that maximum cutoff price. By paying the maximum possible price up front, you are effectively trading away your potential profit margin on listing day. The book building system effectively hands pricing power to institutional demand, leaving retail investors with less room for a pop. Because the official data is so tight, investors often look to an unofficial metric to guess the listing day jump, the gray market premium, or GMP. GMP isn't a regulated figure. It's an unofficial whisper network of what speculators might pay, but it carries no legal guarantee of actual exchange value. This feedback loop shows why chasing high GMP is dangerous. A high premium triggers retail hype, leading to massive oversubscription, which inflates the whisper price further. When severely oversubscribed, your mathematical odds of receiving shares shrink towards zero. You're locking up thousands of rupees for weeks for a lottery where the odds are fundamentally stacked against you. Using GMP as your primary guide almost guarantees you'll be competing in the most crowded, least probable trades in the market. Let's look at the best-case scenario. You beat the odds, you get the shares, and you sell them on day one to capture that 8% average gain. You still have to account for the short-term capital gains tax. This block represents your 8% gross profit. Because you held the shares for less than a year, the government takes a 20% slice of that gain immediately. Once you subtract brokerage fees and platform charges, that 8% gain shrinks even further. Now, look at that tiny sliver of actual net profit and compare it to the total capital you had to risk and lock away for 2 weeks to get it. Factoring in taxes and fees on an 8% return, the math for a retail quick flip simply doesn't support the level of risk. Navigating this saturated market requires moving away from speculative gambling and toward a more disciplined, value-driven strategy. For those who still want to be quick flippers, the rules have changed. As the scorecard shows, a successful flip now depends on high-qualified institutional buyer subscription. You want to see the big players backing the deal before you step in. It also often requires the capital to apply through high net worth quotas, avoiding the retail bottleneck entirely. The alternative is becoming a value builder. A value builder ignores the whisper market. They treat the IPO as a way to acquire a high-quality company of fair price before it potentially appreciates over several years. An IPO serves a specific corporate function, providing the capital a business needs to expand its operations and infrastructure. Consistent growth in the primary market relies on a rigorous assessment of a company's business model, rather than a reaction to the noise of a listing premium.